So we really appreciate Secretary Baker making that video. It's not lost on me that one of the most well-known quotes from Jim Baker about my dad expressed Secretary Baker's frustration when he was Chief of Staff for President H.W. Bush, that Jack Kemp was the only HUD secretary who had a monetary policy, a foreign policy, a defense policy, and while Baker and Kemp maintained a good relationship, they certainly had their moments. But I really am grateful for Secretary Baker doing that, and it shows what we aspire for the Kemp Forum to be, and I think you've seen it today. The Kemp Forum is a debate and discussion series that provides a platform for the civil competition of ideas. We certainly need civility. We need competition of ideas. And this discussion has gone in that direction, and I really appreciate it. Someone who's going to further that competition of ideas is our next speaker, who came on my dad's radar screen in 1987 when he was on the Foreign Relations Committee in the House, and they were talking about how the Soviet Union's finances looked. And he called a young economist to come testify, and I think she must have been 10, 12 years old at the time. But Judy Shelton met my dad that day, and she later, that was 1987, and soon after that she gave him her new book, The Coming Soviet Crash, which Dad proceeded to take to newly elected President H.W. Bush. And Dad and Judy had a very close relationship and friendship throughout the years, and Dad depended on her analysis and counsel, and I'm grateful that she and Gil are friends of ours. Judy has recently written a book called Fixing the Dollar Now, Why U.S. Money Lost Its Integrity and How We Can Restore It. She also wrote a guide to sound money, a book that Dad mentioned at the Empower America conference in 1994 that we saw earlier, called Money Meltdown. Her international economics articles have been published in the Wall Street Journal, the New York Times, Post, Financial Times, the Nihon Keizai, man, I don't know how to say that, and El Economista. Judy, we're thrilled to have you here. Please welcome Dr. Judy Shelton.
Well, the presence of two giants hovers over this conference. One, a politician, the other, an academic. But that distinction is somewhat arbitrary. Jack Kemp was a scholar in his own right, someone who read John Maynard Keynes while riding on the bus to the next football game. And it was Robert Mundell's intellectual activism that powered the Reagan Revolution and laid the groundwork for a common currency in Europe. So you cannot separate thought from action, at least not if you want to change the world. Jack Kemp and Robert Mundell did change the world. Jack was the driving force behind the tax and monetary policies that turned the lost decade of the 1970s into the economic boom that resuscitated world growth. He fully grasped the academic reasoning behind Bob Mundell's supply-side prescription for economic growth, a formula that boiled down to lower tax rates and a stable dollar. No wonder at a time when America is trying to reignite economic growth, while the world worries that trade tensions and protectionism could trigger the next global financial crisis, or that differential interest rate policies among the world's central banks will cause currencies to dramatically shift, choking off growth, potentially leading to regional defaults on dollar-denominated debt, no wonder now we find ourselves turning to the forward-looking ideas of Kemp and Mundell and asking, what do we need to do at this point to turn things around? How do we get back on the path to economic growth, productive economic growth, the kind that actually raises living standards, the kind that leads to shared prosperity, versus the kind fueled by low-interest loans to large portfolio investors who bid up financial markets. What we need is real growth, not speculative profit-taking from gaming the future path of interest rates and the next big currency swing. We need to raise economic confidence. We need a stable, dependable dollar. When Jack Kemp and Robert Mundell hosted their 1983 International Monetary Conference right here in DC, they had some powerful attendees: George Shultz, Secretary of State, Don Regan, Treasury Secretary, Henry Kissinger, Art Laffer, and has been mentioned, the actual proceedings from that conference were published in a book entitled A Monetary Agenda for World Growth. Jack Kemp summed up the purpose for the conference in the introductory chapter of that book. He wrote, "There is broad support to the view that something is fundamentally wrong with the current international monetary system, and that large, unpredictable fluctuations of exchange rates have imposed severe costs on the economic system." The essential question they were asking at that conference was, should we continue with the floating rate system as the least objectionable solution, or should we restore a system of formally maintained exchange rates between the major currencies of the world? And that's the question we're asking here today. My own answer is that we have much to lose by continuing with the compromised and dysfunctional monetary arrangements we erroneously call freely floating rates. I believe we should restore a system of formally maintained exchange rates between the currencies of the world. And I say that having written a book called Money Meltdown, Restoring Order to the Global Currency System, as a senior research fellow at the Hoover Institution at Stanford University. And I say it as someone who was a visiting professor at a graduate business school in Mexico during the 1994 peso crash, and for the years following, where I personally witnessed its devastating impact. And more recently, I say that from having served on the Trump transition team as International Affairs Advisor at the Treasury Department. When you are facing the real possibility of naming major trade partners as currency manipulators, it concentrates the mind. For one thing, we don't have a substantive working definition of currency manipulation. Does it mean that a government is deliberately intervening in foreign exchange markets to distort market forces? What if a government is deliberately intervening persistently, but it's trying to hold its currency up? And let's say those three criteria the Treasury currently uses to identify offending countries in its semi-annual report, let's say by those criteria we could label China or Japan or Mexico or Germany a currency manipulator. To what end? Now what happens? We apply tariffs? Those targeted countries will say, very indignantly, the reason our currencies are devaluing compared to the dollar is because your Federal Reserve is signaling higher future interest rates, which is true. And let's face it, how can you talk about currency manipulation and not talk about central banks and the impact of monetary policy decisions on exchange rate movements? It's disingenuous to pretend you can separate the Fed's influence over the supply of money and credit at home from the notion of dollar stability abroad. Now, there's an overarching theme in all this. Monetary integrity. It's something that Jack Kemp earnestly sought to achieve. He believed the United States as the world's leading free market economy, as issuer of the world's leading reserve currency, should provide global leadership toward achieving monetary integrity both domestically and internationally. Well, how can we do that? Where do we even begin, practically speaking? Let me offer a modest proposal. A modest proposal with a bold agenda, or as Jack would say, an audacious agenda. The overall goal would be twofold: to begin to reconnect U.S. monetary policy to the real economy so that productive, entrepreneurial, risk-taking, job-creating activity is supported, and to encourage America's trade partners to join us voluntarily in taking a small step toward considering new arrangements for a stable international exchange rate system to support global free trade and capital flows. Here's what I propose as something useful and constructive our Treasury Department could do, and do quickly. We could offer a Treasury debt instrument that included a gold convertibility feature. Why gold? It doesn't have to be gold. But since central banks in over 100 countries already hold gold as part of their international reserves, it seems a good, neutral reserve asset. And in my mind, a way to avoid political resentments. So, let's imagine a U.S. Treasury instrument that works like this. On the day of maturity, the holder of the Treasury bond would be entitled to receive back either the face value of the bond or a pre-specified amount of gold. Now, I'll say that again. The day the bond matures, the bondholder gets back either the face value on the bond or else a pre-specified amount of gold. It is their option. So, for example, let's say this bond, we'll call it a Treasury trust bond, is going to mature in 5 years. And let's say the current price of gold is $1,260 per troy ounce. To keep things simple, let's say the face value of the bond is also $1,260. So on the maturity date, the holder of the Treasury trust bond can elect to receive either $1,260 or 1 ounce of gold, their choice, on that date 5 years from now. How much would you pay for that Treasury debt instrument? Well, if you figure the dollar price of gold is going to remain stable over the next 5 years, so that the future price will be the same as today, $1,260, well, you wouldn't pay anything extra for the gold convertibility option. What you would be willing to pay would be the discounted value of receiving $1,260 5 years from now, based on the current rate for a 5-year Treasury note, which is about 1 3/4%. So you would be willing to pay roughly $1,155 today to receive $1,260 back from the Treasury 5 years from now. That's the present value that equates to a 1.75% yield on your investment, which is the current interest rate on 5-year Treasuries. But let's say you are concerned about dollar stability in terms of gold. You think it's pretty safe to lend money to the U.S. government, but you'd be willing to pay something for insurance in terms of future purchasing power. You see gold as an acceptable monetary surrogate. You're thinking, what if U.S. economic growth proves disappointing and the Fed decides to go back into quantitative easing mode to supply more liquidity? The dollar would likely depreciate against gold. Maybe you think Congress will run bigger future budget deficits, and you worry about the impact from that on the dollar. As a Treasury debt holder, you want to be compensated for any future loss in purchasing power due to dollar depreciation in terms of gold. By purchasing a Treasury trust bond, you've locked in the option to receive an ounce of gold at maturity 5 years from now instead of 1,260 depreciated dollars, and that matters because it would cost more dollars now to buy that gold ounce. You have effectively protected yourself from the potential loss of dollar purchasing power in terms of gold over the life of the bond. Think of it as something quite similar to TIPS bonds, which the U.S. government has been offering since 1997. Treasury inflation-protected securities compensate the bondholder for any loss in purchasing power due to dollar depreciation in terms of the Consumer Price Index. If inflation goes up over the life of a TIPS bond so that dollars are worth less, the bondholder is compensated with additional dollars so that they have the exact same purchasing power they had when they invested. With Treasury trust bonds, which I'm advocating, the bondholder is similarly protected. If the purchasing power of the dollar depreciates as measured in terms of gold, they will likewise be compensated by receiving the same amount of gold they could have purchased on the day they invested. It's pretty straightforward, actually. And maybe it's the kind of thing that grandparents buy for their grandkids. Maybe the Treasury initially offers it as a savings bond. It would be a novelty, because for the first time since the end of Bretton Woods, it would establish a link between the US dollar and gold. It might be a good way to explain to the next generation what Thomas Jefferson meant when he wrote, "If we determine that a dollar shall be our unit, we must then say with precision what a dollar is." Jefferson wrote that in 1784 in his notes on the establishment of a money unit for the United States. He had taken on the task of creating a common currency for a newly liberated nation comprised of 13 independent states. The dollar was defined with precision in the Coinage Act of 1792, and it was in terms of a specified amount of gold or silver. Now, it's true that legislation goes back some 225 years. But then again, so does the U.S. Constitution. All right, let's think about what might happen today if the U.S. Treasury were to issue a gold convertible debt obligation. How would other countries respond to that? Would they find it innocuous or somehow threatening? You know, it's interesting. Treasury Secretary James Baker gave a speech in 1987 in Washington at the joint annual meeting of the International Monetary Fund and the World Bank. And in that speech, he announced that the United States would consider using a commodity price index that would include the price of gold as a tool for coordinating economic policies among the major industrial nations. A former deputy managing director of the IMF, William Dale, told a reporter at the time that Baker's proposal was likely just a tip of the hat to the gold bugs in the right wing of the Republican Party, just an idea that Congressman Jack Kemp from New York was pushing as a way to stabilize exchange rates among currencies. Secretary Baker is certainly a Republican, but he's never been a frontman for Jack Kemp. And I don't think anyone would suggest that Jim Baker is unsophisticated in his thinking about international finance and economics and the importance of currency stability. He just testified as much. I would say it was the IMF that dropped the ball. So now let's go back to this Treasury Trust Bond initiative. What if China immediately followed suit and issued their own version of a Chinese government debt instrument that could be redeemed at either its face value denominated in RMB or 1 ounce of gold 5 years from now. Markets would decide what to pay for that instrument with the market-determined interest rate on 5-year Chinese government debt embedded into that price. And now think, U.S. Treasury trust bonds and China's equivalently structured government bonds would essentially be worth the same thing 5 years from now, 1 ounce of gold. Each one denominated in a sovereign currency, but both convertible into the same monetary reserve asset at a specific price. That suggests an implicit future exchange rate between the two currencies based on $1,260 as the face amount on a Treasury trust bond, and let's say at a 7-to-1 ratio, 8,820 RMB on China's government bond. If both instruments sold at par, the implied future exchange rate could effectively become a self-fulfilling prophecy. Now, if the price of one nation's bond comes under market pressure, that's a clear sign the market anticipates one currency depreciating relative to the other in terms of the neutral reference point, gold. That will send an important signal from investors about the growth prospects for that nation and about its fiscal and monetary policies. It could be a very useful tool for the Federal Reserve or the People's Bank of China, just as the yield on TIPS bonds today helps the Fed gauge aggregate expectations about future inflation. Comparing the performance of these parallel instruments would reveal investor expectations about the relative stability of the dollar and the RMB in terms of a neutral reference point. It would provide a starting point for evaluating the trade impact of shifting currencies. We might even go so far as to suggest that in the future, governments might agree to intervene to maintain the par value of their own sovereign debt instrument linked to gold, rather than target a daily fixed exchange rate against a trade partner's currency as China does currently. Clearly, the European Central Bank or its individual member nations could do something similar. The IMF itself is the third largest gold holder in the world. It could facilitate the necessary arrangements for its members to offer such an instrument. In closing, let me note Jack Kemp's observation at that 1983 conference when he pointed out that any new system of formally maintained exchange rates among the world's currencies would need to choose a common reference point, an anchor. It could be a national currency like the US dollar. It could be a commodity like gold, or it could be a supranational invention like the IMF special drawing right, the SDR. Bob Mundell gave his own view. He said, choosing a dollar standard would be like imposing English as a world language. Choosing the SDR, he said, would be like trying to impose Esperanto on the world trading community. Mundell said that a gold standard would be closer to the mark, in his words, given the significant gold holdings of central banks. Quoting Mundell, if all countries agreed to convert their currencies into gold at an agreed price, gold could serve in lieu of the SDR, and the international gold standard would provide the world economy with a common currency, unquote. Let me just say that I believe U.S. leadership can and should play a strong role in helping to build a new stable international monetary system to serve an open global marketplace dedicated to free trade and genuine competition. And if the next Bretton Woods conference takes place at Mar-a-Lago, great. Let's hope it's not too far in the future. Thank you.